know what's funny? We're finally going over something that's actually simple. Yeah, I know, right? Pretty surprising, isn't it, due to all the crazy concepts I've been teaching recently. Anyway, we're going over minor and primary liquidity today. Two very, very simple concepts, all right? First, just to dive right in, minor liquidity. There's two forms of minor liquidity, okay? You have the first form, which is the latest key swing that's formed recently in price, okay? Key swing meaning obvious swings. So I'm going to show you a couple examples of that. Stuff like this, 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 that right there, that down there, this right here, that up there. Key swings. Key swings that are you can see and show it to a beginner and say, oh, price went up right there, price went down right there. And literally a complete novice can tell when price is going up and down. Stuff like that. That is what I mean by key swing. And what I mean by key swing is you want to see it intraday. What I've been seeing from ICT's teachings, though, is whenever he mentions intraday, when it comes to these two concepts, minor liquidity and primary liquidity, he refers to the hour and anything below that. So I'm on the 5 minute right now. But anything on the hour and below that is, considered minor and primary liquidity when it comes to the forms in which they actually, form. The second form of minor liquidity is the current 15-minute dealing range that price is trading in. Doesn't matter if it's before 9:30, whatever. If you're trading Asian session, trading one, it doesn't matter. The current 15-minute dealing range that price is trading in, okay? Any liquidity or any high or low that's within that dealing range on any time frame that's on the 15-minute or below that is minor liquidity. Okay, I'm going to say that again because that sounded a little confusing just for me explaining it. The second form of minor liquidity, okay, is within the current 15-minute dealing range that price is trading in. Any high or low within that is minor liquidity, okay? When you're looking for it within the current 15-minute dealing range, you can look for it on the 15-minute and anything below that. Why am I saying that? Because you're looking at the 15-minute dealing range. Why would you go any higher than the 15-minute when you're looking for liquidity within the 15-minute dealing range? It just doesn't make any sense. Now we're going to go over primary liquidity. I just want to give these definitions to you so when we actually dive into the examples, you won't be completely clueless to what we're talking about. Primary liquidity, okay? The first form of primary liquidity is, like I mentioned earlier, the current 15-minute dealing range that price is trading in, wherever you're at. Okay, if it's 10 o'clock, if it's 4 p.m., doesn't matter. The current 15-minute dealing range that price is trading in, the high and low of the dealing range can be primary liquidity, all right? The second form is whenever a form of minor liquidity has been ran recently, okay, after that's happened, the most logical level of liquidity after that minor liquidity level has been purged, sweep, whatever you want to say, that is primary liquidity. Reason being, when we say logical, we mean in the direction of the narrative, so wherever price truly wants to deliver, and logical meaning there's evidence in price to where it makes sense that price wants to go there. So it can be, if this was primary liquidity, if we say this high right here was primary liquidity, right, we could say this is logical, reason being, is a logical point for price to, run, because we have this gigantic fair value gap above it. Yeah, and it's huge. Literally, if we draw it, that's 117 points. Well, 118 if you want to round it up. Still, that's pretty crazy. So you have this 120 point gap above this high here. Is that not logical? Because what does price do? Price does three things, okay? Price seeks liquidity, price rebalances, and price rebalances and balances, and then the third thing, which is something we don't need to go over, but it tends to rebalance to equilibrium. Those are the three things. But the main two is price always seeks liquidity, and price always rebalances imbalances. Very simple, isn't it? That's why price had such an aggressive move up, or rebalancing this imbalance here, and then running out the liquidity that's right here. Very, very simple, isn't it? I know. Very, very simple. Anyway, enough yap. Let's go over some examples, shall we? So let's probably go to this day here. We're going to jump to the 15-minute because that's how we're going to find our forms of minor and primary liquidity. First thing you want to do before you identify your primary liquidity is the minor first, okay? If you're going to look at these concepts in general, look at minor, then primary. Understood? Cool, cool, cool. That's understood. So we're going to mark the 9:30 opening since that's what we're going to be trading in hindsight, or that's what we're going to be referring to here. Let's find the dealing range that price is currently trading in, okay? So, and how we find that is you find the most recent liquidity purge, all right, from both sides, buy side and sell side. So we need to see price come down, hit sell side, and then come back up, hit buy side. Very simple, isn't it? And we're looking for something that's pretty crucial. So we don't got anything here. Now we can zoom in to these, to this weird looking price action here. Anyway, we have a liquidity purge here. Price comes down at all these equal lows, rallies back up. So we could consider that the dealing range from here to here. And then price comes down into this short-term low here. But it's very, very minuscule. It doesn't have much of an importance. So me personally, I would mark it from this low here all the way to the high up here. What is my mouse doing? Jesus Christ. Anyway, all the way up to there. Now, how in the world did I get that dealing range? The deepest swing after sell side has been purged, price rallies back up, purges a lot of buy side, so obviously this entire run is purging buy side, and then the deepest swing created after buy side has been purged. Once you get those two deepest swings, you draw it from the low to the high or the high to the low, it doesn't matter, and there you go, you have your current 15-minute dealing range. So any high or low within this dealing range is considered what? Minor liquidity. So this low here, minor sell side. This low here, minor sell side. And even this here, minor buy side. Whoa, pretty cool, isn't it? So we have minor sell side here. We got sell side liquidity. And then guess what? More sell side liquidity. Whoa, interesting, isn't it? I know. Pay attention real quick. Okay, just pay attention. So these are the two forms of minor sell side liquidity we have. Remember, this isn't just used for expecting liquidity purges. This can be very small targets that you can use. Okay, if you want to catch 10 points, 50 points, 40 points, 30 points, 5 points, doesn't matter. You can use the minor what? The minor sell side liquidity here. So we have this high within this dealing range. Price comes up and hits this minor sell side liquidity right here. So what does this become? This becomes a liquidity purge. So since we have that run on a previous level of minor liquidity, what do we look for next? What do we look for next to target? Some form of primary sell side, because we had a run on minor buy side. The level of primary sell side we'll be looking for would be, drum roll please, this right here. Bro, I'm making it seem so cringy. What the world? Anyway, it's this down here, reason being, it is the low of what? The current 15-minute dealing range that price is trading in. Does price hit it? I think so. If I move the line, I think it hit it, right? You mark this as a primary sell side. Primary sell side liquidity. If we look and really zoom in, I think it did, right? Yeah, I think it did. So there it is. That's just one example right there. We're probably going to go over 2 more because I do not want to make this video longer than 20 minutes or even 15. So we're going to go to the previous day, which is around here. Alrighty. So we're going to mark before the 9:30 opening, which is right here. Surprisingly, why did price shoot up like that? That's weird. Oh, it's a news event, no doubt. I think that was CPI. Yeah, that was CPI. Okay, here we go. So that's 9:30 right there. The current dealing range that price is trading in before that would be the current dealing range. It'll be from here to here. This low all the way up to that high. Reason being, if we look at this swing here, this swing is coming down and purging sell side, and that's the deepest swing after price is purged sell side. And then we have price come back up and take out buy side. That's the deepest swing after price takes out buy side. So from that low to that high is the what? The current 15-minute dealing range that we are trading in. Very cool, isn't it? Very, very cool. All right. So now that we have our dealing range, let's go look for some minor liquidity, shall we? We're going to drop into the 5 minutes since there's obviously no clear levels of minor on the 15-minute. Here we go. We got a form of minor sell side right there. How? Because it's just a low. Where is this low? It's within the dealing range. So what is this? This is a point of minor. Can I spell? Am I slow? Minor sell side liquidity. Does price hit it? Oh, it does. Oh my goodness. It comes below that low. How interesting is that? comes down, hits the minor sell side liquidity. So where's our primary buy side? If price is purged minor sell side, where's our primary buy side? The high of the dealing range. Okay, that's just the easiest way to do it. High of the dealing range right there. So that can be your target. And you want to see how big that target is? If, for example, you were to, I don't know, let's see what PD array you could have took here. There really isn't a PD array you could have took. Yeah, no, there really isn't one if we were just on the 5 minute, but I'm sure if we drop to the 1 minute, we'll get something. But if you were to enter maybe around here and target that high, that'll give you about 148 points. But, you know, let's confirm that you would get an entry by dropping lower to the 3 minute. Let's see here. Yeah, you could have took that immediate rebalance. Yeah, that right there. See? I knew there's some sort of immediate rebalance. Price comes up. First candle, second candle, third candle, comes back down, rebalances to the first candle's high. Whoa, pretty cool, isn't it? Once you see price respecting it and have some movement back up, that's your entry. Boom, you're in. So from about right here, when price starts delivering, we're gonna set a long position right about there, and you're gonna have your stop at the bottom of the fair value gap that was once there, and then your target up there, which is, how much is that? 118 points. It's a pretty decent amount. Of course, this is a 1.5 risk to reward ratio, but oh, you know what JJ is gonna say? If we were on the 15 second, we can get a lower entry with you know some better risk to reward. Of course, I'm gonna say that. Of course, we're on the 3 minute, guys. You know I go down to 30 second, 15 second. I go down there, as one of my trader friends call it. They call it the ghetto. I go down to the ghetto. All right. So just from looking at this on the 3 minute, you could have got an entry and targeted primary buy side liquidity. Forgot to mark this as primary, but there's that minor sell side liquidity getting purged. Right here, boom, liquidity purge. Come back up, break your market structure. You can also take that fair value gap too. If you wanted to take that, let's drag that up. Can I drag it? Thank you. If you wanted to take that fair value gap there and set your stop at the low of the fair value gap after the break in market structure right here, you could have did that. Would it have worked? Let's see. Would it have worked? Oh yeah, of course. If we drag it over, yeah. That would have been a nice 2.5 risk to reward. So yeah, that still would work. But of course, this is in hindsight. We don't know what you would have done in real markets. But that is just an example right here, your second example of how you can use minor sell side or minor liquidity and primary liquidity to look for liquidity purges and to set targets for your trades. Real simple, isn't it? Yeah, very, very simple. Remember, for your primary liquidity, okay, you can look for the most logical levels intraday, and like I said earlier, whenever I'm mentioning intraday for these two concepts, I mean the hour and anything below that. So here we are on hourly. Now let's see if there was any other logical levels that price could have hit in that, delivery higher. This is our example right here. And if I highlight all the drawings, that is the delivery high right here. So let's scroll over and see. We're going to look in the past. If we scroll over, what do you see? If we, just from the example right here, what do you see? What catches your eye? Do you see anything? If you probably see it, you probably don't. Well, this high all the way over here. You're probably like, what? That? Why that? Well, I'm going to show you. Give me a little minute, okay? Now, if you zoom in, there's a reason I just marked that intermediate term swing. For the ones that have been with me for a while, you know exactly what that means. If we zoom in, for the ones that don't know, if you have a swing, okay, you got a swing right here, and you have two short-term swings in between it that are relatively close to each other in price, that makes the swing in the middle a what? An intermediate term swing. Whoa, what does that mean? That price, before hitting this swing, it must do what? It must manipulate first, in which it's already done. As you can see here, it's already dropped lower. Before it comes all the way back up, all the way back up, all the way back up, and hits the intermediate term swing. Whoa, crazy, isn't it? Yeah, I know. So there's that vicious manipulation down here. The very vicious drop, over 2,000 points, I think. Well, no, 1,000, but still. We had that vicious manipulation after the intermediate term swing was created, so that was delivered. Now, we can distribute into the intermediate term swing. Does that happen? Yep, it does happen. Now, just because it's an intermediate term swing and price can come up to it later, we still need confluence that price will hit this. We need that. So right off the bat, we're going to grade this swing. I'm going to go over grading in a minute. You don't know what that is yet. we got this mitigation block here, this fair value gap, another mitigation block here, another fair value gap. We have a lot of reference points in this swing. So we have to see how price is treating these PD arrays. We're going to first mark this fair value gap, drag it all the way out, maybe about right there. We got this mitigation block right there. Well, no, we're going to mark the high of the mitigation block, which is right here. So if price was truly wanting to hit this intermediate term swing all the way up here, it would disrespect opposing PD arrays, right? So the expected disrespect of the mitigation block would be above this high. And then the disrespect of the fair value gap would be past equilibrium. Does it do that? Yep. Then another confluence is the dealing range. This dealing range right here. See this right here? Price comes up above the equilibrium, right? Does it have a willingness to come back down? Like, do you see that? Like, after it truly comes up above the equilibrium, does it show a willingness to drop back down into a discount and stay in a discount? No. It's showing that it wants to stay in a premium. So, since we're getting these confluences, all right, and we see that all the discounted PD arrays have been violated already, and the premium PD arrays are getting violated already, what does that tell us? That price wants to go higher. So, since price wants to go higher, where is the next logical level for price to go to on that trading day for our example? The intermediate term swing that formed on July 31st. Whoa. Whoa. How in the world did he do that? I know, it's crazy, isn't it? It's just price action and analyzing. It's not much. Anyway, if we drop back down to the 15-minute, right here. Here we go. We drop back down. And we delete all these levels. You can already see what happens. Price hits that intermediate term swing. That's our next logical level. It comes up. Boom. The intermediate term swing is ran. So that was your primary target right there. Because if we look, anything after that high is nothing. We're literally at all-time highs. There's nothing after that. So another confluence that says this is logical because this is the all-time high. And once it breaks that, it's just a new all-time high. So we got it as an intermediate term swing, and then it's the all-time high. So I don't have to explain when it comes to the all-time high thing. You know what I'm talking about. But that was just 2 examples. Well, was that 3? Something like that. I think 2 or 3. Anyway, enough yap. I'll be in this video here. I don't want to make it extremely long, like 30 minutes long, because my videos have been getting longer over time. I hope I taught this well. I hope it can help you when it comes to your insight and analysis on these rigged markets that's ran by algorithms and central banks and all that. And I'll see you guys in the next teaching. Good luck and good trading.